Well, welcome back to the Armchair Trader podcast. I apologise in advance to listeners if my voice sounds a little bit croaky, but the hay fever season is in full swing here in the UK, and I've been suffering a little bit. And today we're quite excited because we're actually able to get Paul Ffolkes on the podcast to talk a little bit about the Japanese small cap space. He's the chair of the Nippon Active Value Investment Trust, and also he's with Rising Sun Management, who are the advisor to that investment trust. But it's a to me, very interesting and very different approach to the Japanese equity market. When I first started out as a journalist, most of the Japanese equity funds were very much long-only, large cap plays, but Paul's going to be telling us a little bit more about their approach today. Welcome to the podcast, Paul.
Thank you very much for having me.
Now, just quickly, for those who are not familiar with it, can you give us a summary of Nippon Active Value and indeed Rising Sun itself?
Yes, of course. Let me correct one thing. I'm not the chairman of Nippon Active Value Fund. That has an independent board entirely based in London. I am the chairman of Rising Sun Management Limited, which is the advisor to Nippon Active Value Fund, and if you like, makes the investment decisions, which are then approved by the board of the fund. The fund being, as you rightly say, a London listed investment trust, and Nippon Active Value Fund being an activist fund in the small Japanese space. And let me tell you how we decided to begin it back in February 2020, just before the pandemic. And this will require a little bit of a history lesson, and it relates to a man called Jamie Rosenwald. Jamie's my partner in this venture. He's been investing in Japan for over 30 years and got the bug from his grandfather, who was the first ever employee of Nikko Securities in the 1960s. Jamie decided to set up an investment business called Dalton Investments in the States, in California, about 30 years ago, with another partner called Gifford Combs, who's still with us and still involved. Their idea was to invest in owner-operated or entrepreneur-operated businesses where there was a confluence of interest between the management and the investors because everyone was an owner, and that they could therefore have a friendly dialogue with managements, and over time the stocks would grow and everybody would have an aligned and felicitous time. Over the years, he's noticed, however, that the number of owner-operated business or entrepreneur-operated business in Japan is about 15% of the total. Japan is a market which has an extraordinary number of listed companies, both large, medium, and small cap, and the vast majority of these are run by what is these days known as salarymen, people who are employed to manage a company. They normally don't have an interest in the business, or if they do, it's a very small stake. They tend to run the business in a conservative manner, remembering the trouble that a lot of small businesses had when the bubble burst in the late 1980s for Japanese companies and they couldn't borrow money. They now pile cash on the balance sheet to the point where it doesn't bear any reality to what they could possibly need to run the business, and they don't know how to allocate that capital. So Jamie's for a long time wanted to set up a business that would go after these sorts of companies, initially on a friendly basis, but showing more aggression over time if management continues to display a reluctance to change. And change is a word that is quite interesting in Japan, and I know it's probably a question you're going to ask me about a bit later. But we set this business up to give us a source of permanent capital because these instruments are often quite volatile and quite illiquid. So we wanted to have security that we would have money available. We launched the company in February 2020 with £103 million. We always felt that that was a bit less than we should have liked, and it rather forced us towards the smaller end of the small end market. So we also created a couple of special purpose vehicles for US investors who, for whatever reason, couldn't invest in the UK investment trust, and many of them can't buy a sterling instrument, to bolster the funds available. And most recently, things are changing with regard to the relationship with Nippon Active Value Fund and Dalton Investments itself, but I can come on to that.
Now, I mean, obviously, you mentioned the timing of the launch. You obviously weren't to know at the time that we were about to hit a major, once in a century global pandemic. Japan itself obviously locked down like a lot of other countries, and the Olympics got delayed as well. I've spoken to other Japan equity managers who are based outside Japan who had a lot of difficulty. Well, they found it, in fact, impossible to actually get into the country. What's your impression of Japan, the economy as it emerges from the pandemic? And secondly, I know you've actually managed to get there last month. What's been your impression, having had the opportunity to actually get into the country and meet companies?
Yeah, well, you're absolutely right. They did lock it down, and we were unable to get in for about the first 2.5 years. But luckily for us, the structure is that the president of Rising Sun Management is in fact a Japanese M&A lawyer, Kazutaka Mitsuochi, and we have an office via Dalton that's been in Japan for 12 years. So we have quite a lot of feet on the ground and have been able to pursue our strategy unhindered, if you like, by the fact that Jamie Gifford and I were struggling to get there. As you point out, we did manage to get there last month, and boy, what a palaver that was. You have to go to the consulate to get a visa, you have to have a PCR test 72 hours before you leave, it has to be uploaded on a very arcane Japanese tracker. When you arrive, there are 11 different stations you have to go to in the airport. It takes over 3 hours, including a new antigen test, which you have to wait for the results for. So you'd have to say that they weren't making it easy, but when we got in there, it was actually very interesting. My impressions were that Japan is as busy as ever. That the streets were bustling. We took the bullet train to Kobe and Osaka to see some of our client companies. Everything is running with its usual efficiency. You know how stiflingly formal the Japanese can be, so that's still there, and it's one of the things you have to try and overcome. But it was actually very, very helpful and rather nice to be able to meet people we've been talking to on Zoom for 2.5 years in person. And I think they are now starting to further relax the lockdown provisions, although I think largely for large groups at the moment. So businessmen will still have to go through quite a lot of hoops in order to visit. In terms of how the company, or sorry, the country is recovering from the pandemic, well, this is a function of so many small companies. Some have done okay during the pandemic. A lot of our companies have sort of marked time, but actually no one has suffered horribly. Some have actually benefited very positively, particularly companies in ESG and other spaces which have become more important because of the pandemic. The nature of our client base or the nature of our portfolio base is that we tend to invest in smaller widget making type companies, companies that might make canned pumps or pipes or valves or rubber belts. These are companies that perhaps in the UK and certainly in the US might not exist at all. They would probably have already been consolidated into the supply chains of the larger companies that they serve. It's one of the reasons why we thought they would be an interesting investment, because there are lots of things that we can suggest to companies like this. And all of our companies have done well. No one has suffered. Over the period that we've been investing, we've made some discoveries about one or two companies being just a little bit too illiquid. So we've divested from those. But on the whole, we started with 20 names and we've still got, I think, 17 of those. And it was very, very good to be able to meet management and finally put our points across in person.
Can you talk a little bit more about the small cap space in Japan. I mean, a lot of our listeners will obviously be outside Japan and will be more familiar with, say, the UK or the US small cap space. You've mentioned that the management at a lot of these companies are not actually themselves heavily invested in the business. Are there any other characteristics that you tend to find when you're doing your research on that particular part of the market?
Yeah, well, there's one characteristic they all have in common, which is whenever you say something to them, which would involve them doing something different, the initial reaction is no. But then you start to have a discussion. So, as I said, a lot of our companies are smaller companies. If you look at the kind of relative value of stock markets in the developed world, and we always follow what GMOs say, the big GMO, the big Boston um, fund management group, they put out a comparative research every month on what they think the best or the cheapest markets are. Consistently since we've started, Japan's smaller companies has been, they think, the cheapest area of any market. So we think we're fishing in the right pond. What we try and do with managements that have a reasonable business, but no real interest in growing it very quickly or using what can be a half or even 100% of their equity value stashed on the balance sheet in the form of either cash or cross shareholdings in companies that they do not need to hold and derive no benefit from holding, or even strategic investments, again, for no apparent reason. So cash is one of the things that is in our sights. The other is a willingness to hear us. So uh, what we've done in the past is call managements. They will always take a call. They're unfailingly polite. We've had many conversations which we thought went very well, and then the company does practically nothing on what we've suggested. On the other hand, in two or three occasions last year, and I've spoken about these in the various quarterly updates that you can find on the Nippon Active Value Fund's website, companies have actually followed or done some or all of the things we were suggesting. In one case, Sakayovex, the company took itself private. In another, Ibarra Sugio, they've raised their dividend four times in a very short period, and the stock price tripled. You don't always have those sorts of successes, but at the end of 2021, the fund was up over 50%. And that was probably, I think, the bet, well, according to our brokers, Shore Capital, that was the best performance of any Japanese fund in the UK. We've suffered a little bit since then, not only because the markets are softer, but actually the real problem for us is that we are a fund that is denominated in sterling with yen underlying investments and a mandate not to hedge. So that has cost us 17 or 18% this year. At some point, it will start to reverse. But you asked a question about how is Japan. I'd say the Japanese economy is on pretty good footing because it is the second industrial economy on the planet, probably, and still one of the great car makers and car exporters. And of course, it is benefiting greatly from Kuroda-san, the central bank's governor's policy of allowing the yen to stay weak. And I think it's a testament to how much the Americans think that they need such an important ally in Southeast Asia that they're not screaming and shouting about the ongoing weakness of the yen, because were it anybody but Japan, they would be. So Japan's getting away with murder at the moment in terms of devaluing its currency, and that is actually pretty helpful to most of our portfolio companies, pretty unhelpful to investors who are paying sterling for a yen asset.
Talking to that point, would you say that many of the portfolio companies you look at are less export oriented and more domestic focused? Because that's often the case with small caps.
I'd say that was probably fair, except that the nature of Japanese business is that most smaller companies are selling their product to only one or two larger companies. So let's take the example of a company we've had quite a bit of success with this year, a company called Mitsubishi Belting. They make belts for combustion engines, for industrial purposes generally. even for carousels and things like that in airports. But their most important customer is Toyota, and Toyota is clearly exporting a large number of cars every year. So it's the kind of company which produces an extremely high quality product, is much smaller than it might be, has other competitors like Nita who look very much like it, and would have been consolidated into the supply chain anywhere but Japan. The reason that I mention them is that only with the slightest of proddings, we wrote them a letter this year for their AGM suggesting two principal things that they might do, which is award themselves large-ish amounts of restricted stock, which is the recommendation of the financial authorities as part of the corporate governance reforms, and I'll talk a bit about those in a moment, so that the management and even the rank and file begin to have an interest, a financial interest in the company. And also that they should engineer a 10% buyback of the outstanding equity over the course of the next year. Now, when we spoke to them about our letter, they said, look, if we do some of these things, are you willing to withdraw your proposals? And we said, well, we can certainly talk about it. What do you have in mind? And they said, well, we will initiate a restricted stock program, which they have done. We will initiate a buyback, which they've also done, albeit for less than 10% and over 3 years, not one. And we will pay out 100% of earnings for the next 2 years in the form of dividends because we accept that we have more cash on the balance sheet than we need. Now, that's the first company that's ever told us that they accept that, but they've done it. We said, yes, that will do it. We will withdraw our proposals, which is good for them because they don't like conflict at their AGMs and they don't like criticism of the management. And the stock rallied on the back of that last month 40%. So currently it is our largest holding by value, but it wasn't until they carried these reforms out. Let's just talk about reforms for a moment because it gives the whole basis for the Nippon Active Value Fund. In 2014, the Abe government decided that they needed to do something about the value of Japanese companies. Now, this wasn't a kind of disinterested desire to help foreign or even domestic investors. It was actually really motivated by self-interest. The largest shareholder in Japanese companies are two, the Bank of Japan and the National Government Pension Fund. So the Japanese government, if you like, is a more than 12% owner of just about every stock in Japan. So getting that market to move, getting the market to perform and think more like Western markets was in the interest of the government itself. So they began a corporate governance reform program, pushing things like greater diversity on boards, more independent directors on boards, how companies should listen to shareholders, how they should award themselves restricted stock, etc., etc. They followed this program to date, so they've continued to do this. And one of the most recent and most important developments in Japan has been the restructuring of the stock market itself in April, which was a moment when the government was trying to get a lot of what until then first section companies onto either lower section companies or even out of the stock exchange altogether. We're talking here about companies that can be sub $100 million of market cap being on the first section of the stock exchange. So these companies were struggling to make prime, which is the new name for the first section, with new criteria to be a member. And that gave us another lever, if you like, to pull in our discussions with management about why don't you do things which will actually help you either make prime or not make prime because you're not going to make it and you're wasting a lot of time and effort trying to do it. So it's been an interesting time, but it's given us a really fair wind to engage with management.
When I was writing about Japan for the Far Eastern Economic Review back in the 90s, I spoke to a lot of fund managers at that point who were foreign fund managers invested in Japan. and they complained a lot about the culture you mentioned, how shareholders were really just meant to be passive and quietly just sit there and listen politely to what management told them and not complain and not get activist at all. Now, some of these were American fund managers who were running a global mandate and were used to being activist, and they ran into all sorts of brick walls in Japan when they tried to apply the same tactics there. Some of what you do as a fund manager involves that, it involves coming up against that culture. I know there's the pressure now from the government for reform, but with some of the positions you've taken, you're actually coming into the company and obviously hoping that you get management that's cooperative, but presumably you also run into that same kind of brick wall scenario where management is uncooperative. Does that mean that you have to take the gloves off to an extent to get things done?
Japan reminds me a little bit of the governing body of most Cambridge colleges. When I was a bursar, we used to have a joke all the bursars told about their colleagues behind their back, which was, how many Cambridge dons does it take to change a light bulb? Care to take a guess?
I've got no idea.
The answer is change. And that's a little bit like corporate Japan. So, yeah, there are two constants about corporate Japan, which fund managers will always tell you, which is Japan is always cheap and always has been. You're right, and it still is, but we're trying to make it a little less cheap, and that nothing changes. Or if it does, it changes very, very slowly. But I think the example I gave you on Mitsubishi Belting is an example of how things are beginning to change. Because here is a management that actually came to us and said, look, we're going to do these things. Will you meet us halfway? And we said yes. So we will make a lot of that in our materials and in our discussions with other companies. You're absolutely right that the initial reaction, whenever you tell a company, we think you should go private, they'll say, no, we shouldn't. Or we think you should do a buyback or pay us more in dividends. So then and the answer is always no, initially. So then we start the discussion about what share ownership is. And we say, we're not just another stakeholder, we're your owners. We own the company. And if you don't start listening to us, and in many cases we are the largest shareholder in the company, we will start to, as you put it, take the gloves off. And there are a number of ways that we can do that. A, obviously, by increasing the amount of stock we own, making very public comments about what we think they could do better, while always trying to congratulate them on what we think they do well. But ultimately, all these companies are being circled by private equity in Japan. The only difference between private equity in Japan and, say, the States or the UK is private equity will act as a principal in the Western markets. They will go after companies, as we've seen with a lot of the large companies going after companies very publicly. In Japan, they prefer not to be seen as aggressors. This is a nod to the traditional courtesy of the Japanese market, and they believe that with the number of activist investors operating at the moment, of which Nippon Active Value Fund is only one, but there are quite a number, both British, American, and a lot of Japanese. In fact, you might argue that the most effective of all the activist investors is Mr. Murakami, who operates his own family office, instills a great deal of fear in companies on whose share register he appears. So it's becoming much harder for Japanese companies just to say no. They have to engage, they have to talk to you. And after a while, they begin to think, well, actually, this isn't necessarily the silliest thing we've ever heard. What is singularly absent from their mindset, and it is very interesting, is there is no greed. So normally when you're proposing to management, but why don't you pay yourself a lot of restricted stock, and 3 to 5 times your annual stipend, and you can have it for nothing, and then you've got an interest in your company, and you'll see the share price go up, and you'd think their eyes would light up at this point, but it tends not to. They give you a whole lot of stuff about we don't want to have too great a disparity between the highest and lowest paid in the company, and this isn't the Japanese way, etc. It's certainly the thinking of the Japanese authorities because they were the ones who came up with the idea of restricted stock programs. So it's changing, but greed is missing, and that makes things slower than it might be. But not only can I point to things like Sakai Ovex, which is a small company that took itself private, you can see what's happening to Toshiba at the moment with the larger activists, which will be broken up into its component parts. It's a rather strange contrast that the very big companies probably need to be broken into component parts. The very small companies probably need to be consolidated into a bigger one. But that's one of the anomalies of the Japanese market. But are things changing? Yes, they are. Slowly and increasingly, we're going to accelerate this process, and that means we need more firepower, and we've found a way of generating this. Okay, so two things really have happened recently in the Nippon Active Value Fund realm. One, as you pointed out, we managed to get to Japan. Not only did we meet our portfolio companies and a lot of the PE companies who are circling our portfolio companies, and into whose arms we think they will run if we cut up rough. So one of the things I think you'll see an acceleration of is PE activity and small companies going private. But we also detected a sea change in the attitude of the banks to finance this activity. Traditionally, there are three large money center banks in Japan. They number most corporates amongst their clients, and the last thing on earth they would ever do would be help, lend money, or front an aggressive approach to one of their companies from an activist investor, especially not a foreigner. However, there is a large secondary banking system in Japan, largely regional banks, and there are many branches of big international banks operating there, and their attitude is starting to change. Now, I think it's because of another very important breakthrough that happened a couple of months ago when SBI, which is one of the Japanese activists, managed to effectively gain control of the Shinsei Bank, which is the old long term credit bank, by making an offer for 48% of its equity. This is something new and has created what can only really be described as a grey area in the minds of financiers. If you try and take over 50% or control of a company, it's clear, and the company doesn't want it, then it's clearly hostile. But there's a new area which the banks themselves are calling unsolicited, where they have expressed a willingness to help us go after some of our companies, providing they're not clients of their own. So we're now in discussions with several banks, and including the branch of one very large European behemoth, who have expressed a willingness to do this for us. This is new because until now we would have had a lot of trouble getting bank financing for any kind of aggression towards a Japanese company. The other thing that's changing is that Dalton Investments itself, I won't call it our sister company because it is run with completely separate management and based in the States, and it's a subscription business. But Jamie and Gifford are coming to the conclusion that they can see how well we're doing with Nippon Active Value Fund, and that first generation of owner managers or entrepreneurs who started businesses in Japan are either retiring or dying, or there is a change going on, a generational change. And some of these companies that they've owned for a long time in Dalton aren't performing as well as they should do. And they think that a little bit of activism is called for in the Dalton portfolios. Well, Dalton controls about $2.3 billion of Japanese companies. So when you combine Nippon Active Value Fund and its two SPVs, which come in total to about $200 million, with the firepower of Dalton, you begin to get really a much more effective vehicle to go after companies aggressively.
You mentioned the private equity funds and the banks. Does that make a difference then when you're looking at potential future targets in terms of who's already on the shareholder register or who's already potentially positioned around a specific company?
Yes, it does.
Is that a big factor?
Yeah, a large factor. I mean, our selection criteria, apart from looking for what we think are good but not necessarily brilliant businesses, i.e., businesses that could be run better and could have better capital allocation, is that we also like businesses that don't have a lot of major shareholders, particularly of the conservative type. Other activists, yeah, we're quite happy to see other activists on the shareholder register. PE, they tend not to buy until they buy the whole company. So you don't necessarily see PE funds on the register. But what we do when we start to look at a company is try and identify those PE firms who have a reputation in that industry or who may already be looking. And we do have a conversation with all of them. So we know the guys at Bain, we know the guys at Carlisle, we know the guys at JIP, and we say, we're looking at these companies. Any views? Do you like them? And we get a sense, normally for every stock that we buy, who is the most likely PE partner for that company in the future. Now, insider trading laws are very clear in Japan and very strict, so you can't combine with these guys, you can't give them inside information, and we never do. But it is helpful to to have a general dialogue with these sorts of companies to say, um, how's your business? Uh, what are the areas that you're particularly interested in? And we know just about who would be interested in every single one of the companies that we buy. We also tend to like to buy companies which do not have third-party brokers following them, so there isn't much research out there. So they're a bit of a void in the knowledge universe, and that gives us a chance to get to work on them.
And I just wanted to ask you briefly, you mentioned earlier on when we were talking about the sterling yen hedge and how that's obviously impacted, the lack of it has impacted the performance of the trust. Can you explain why that decision was taken, and is that something that you attempt to revisit going forward?
Well, it's a good and obvious question. The answer is, not wishing to sound Japanese, but no. It's in the prospectus that the foreign exchange will be unhedged. It was something we were asked by the exchange when we first listed. It was a decision made not to hedge the currency. You may be a better market timer than I am, but I have a horrible suspicion that if we did try and start hedging, we'd get it wrong and miss the day when the thing moved 3 or 4%, and the reverse started happening. So sooner or later, the Americans or someone will tell Mr. Kuroda, "Okay, you've had your fun. You've got to start tightening this up again." And goodness me, thank goodness we're in sterling, because if we were in dollars, it would be even worse. Sterling not being the greatest performer itself over the period. So we're not foreign exchange traders, and we don't propose to become them.
Just briefly before we finish, I just wanted to ask you, I mean, to summarize what you feel this particular investment trust offers UK investors, as opposed to, for example, the more sort of what I would call vanilla Japanese equity funds.
Well, I think you've put your finger on it. We are not market correlated effectively. Yes, our shares will go down because we can't engage with all of them all of the time, but the ones that we're talking to at any one time do not tend to perform in line with the market because they're doing something specific to address their shortcomings and the share price. So, what I think you get with the Nippon Active Value Fund that you don't get with a long only large cap fund is A, you're fishing in the cheapest end of the pool, and B, we're trying to make things happen. You could say that about any activist fund anywhere, that the returns shouldn't be terribly market correlated, and we've outperformed the index markedly. What we need to do is get bigger, because the bigger we are, the bigger the companies we can go for, and also the more people we can deploy, to go after all of our companies all the time, which we just have a capacity constraint at the moment that doesn't allow us to do that. But we're getting there, and now that we're getting closer to Dalton, it's becoming much easier. We now have dedicated analysts for Nippon Active Value Fund as well as Dalton working in Tokyo. So we are in the process of ramping up the pressure, and I think we're going to see some quite interesting developments over the next few months.
So basically, more boots on the ground, so to speak, will mean more opportunities.
Yeah. The larger your fund, the more of a company you can own. The more of a company you can own, the easier it is to influence the management and to tip them in the direction that you think they should be going, which might be reform, might be an MBO, might be advice from an investment bank, which they don't tend to have on board. One of the things we've learned is that smaller companies are not advised by investment bankers; they're advised by their banks. So when Sakajovic took itself privately, it was Mizuho Bank, not Mizuho Securities, who gave them the advice and did everything. And the banks are very strange. They don't seem to want a piece of the private action. All they want to do is lend money for a really low percentile return. So it's good because money is cheap if you can get it. It's bad because they're not receiving very good management or structural advice from their existing advisors.
That's been fascinating, Paul. Thank you very much indeed for coming on the show today. I think it's been a great insight into a very original approach to the Japanese equities market.
My pleasure.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.